Number one, risk control. I believe it's easy to make money in the market. That's especially true in the good years, and most years are good years. The challenge, the real skill is to...
My whole career has been built on doing things that were uninvestable. As you said, high yield bonds in 1978, distressed debt in 1988, emerging market equities in 1998. These are all things that were under a cloud at the time we started, and they've been successful. That doesn't mean you should buy everything that everybody else considers uninvestable, but that is the place.
Never know where we're going, but we sure as hell ought to know where we are. We're no longer in an easy money environment. If it's the change I think it is, then what you should have in your portfolio going forward can be very different from what it has been.
Howard Marks is the billionaire co-founder and co-chairman of Oaktree Capital Management. Oaktree is a global investment firm that specializes in distressed debt, credit, and real estate. It was founded in 1995 and today manages approximately $193 billion in client assets. Howard is renowned for his common-sense approach to investing, which he has detailed in his two best-selling books. The first book was entitled The Most Important Thing, and the second book is called Mastering Market Cycles. He continues to share his thoughts on the markets and writes regular memos that are read by money managers around the world. Legendary investor Warren Buffett has said that Howard Marks' memos are the first thing I open and read. I always learn something. While billionaire hedge fund manager Seth Klarman says that Howard is one of the very few people who have a consistently original perspective on markets. Later in the video, we will show you how to access Howard's memos for free so that you can stay up to date on what he is thinking. They are a must-read for any serious investor.
If you're the kind of person who has to be right all the time, you shouldn't be in investing, right? And as I say here, if I could know only one thing about every investment that I was considering, it might be, in order to outperform, by definition, you have to depart from the crowd. You have to hold a different position, and you have to have resolve to do it.
Today, Howard Marks' net worth is estimated to be $2 billion. How did he do it? What are his investment principles, and what can we all learn from him? In this short video, we are going to study Howard Marks' investment process, learning directly from him in his own words. Let's get started. This channel is focused on delivering the highest quality content about the ideas shaping global markets, finance, and investing. If you have enjoyed this video, please subscribe now so you don't miss any of our quality content or free resources. Additionally, please provide any of your thoughtful questions or comments below. We value your engagement and input. Finally, in the description below, there is a link to a free reading list of the 100 must-read books in finance and investing. For each of the books, we have provided a short summary so you can focus on what interests you. The reading list covers a wide range of topics, including personal finance, investment strategies, financial markets, behavioral finance, real estate, and even risk management. There is literally something for everyone. The first principle of Howard Marks' investment process is risk management. For him, it forms the foundation of all investing. Nothing is more important than understanding and managing risk. Howard emphasizes risk management over and over again in his writing and in his interviews. Howard writes, "The most important thing is to control risk." Most people think of the concept of risk as synonymous with the probability of loss. In reality, it's the risk of permanent loss of capital that is the most important thing to understand and manage. Howard emphasizes that the ultimate goal of risk management is to avoid permanent capital loss, not just to minimize short-term volatility. Howard in this clip reminds a room full of investment professionals that managing risk is their most important job.
I think the most important job of the professional investor is to manage risk. And, Greg in his talk said, "What do you believe in?" And I think that's very important. And you could hear in his presentation how much of the time they devote to assessing, managing, and balancing risk. And we have to do the same thing. We have to assess it and manage it, even though we do it from a bottom up, micro level, not top down. But I think that you have to constantly work with risk, but you have to never assume, as Mark Twain cautions, that you know it for certain. We never know what is going to happen, and the events show that in the world. We never know how the market will react to what happens in the short run.
Here again, in his writing, he says, "There are few things as risky as the widespread belief that there's no risk." Howard, time and time again, warnings against complacency and the dangers of assuming that a lack of visible risk means there is no risk. The next principle we are going to study is second-level thinking. Howard believes that successful investing requires thinking differently and better than others. It's about having a different perspective and seeing opportunities and risks that others don't. Howard explains it this way in one of his books. First-level thinking says, "It's a good company, let's buy the stock." Second-level thinking says, "It's a good company, but everyone thinks it's a great company and it's not. So the stock's overrated and overpriced. Let's sell." Howard again reminds investors to think differently.
The other thing is, people believe that there's kind of a direct and mechanical linkage. If a company has a good event, the securities do well. If they have a bad event, like earnings, securities do poorly. But that's not the case, because there's a intermediate step, which is people's reaction.
He continues, "To outperform, your thinking has to be different and better. Being different is essential if you want to be better. And being different is unlikely to be enough. You must also be correct."
In order to be confident in giving buy-sell advice, you have to be confident that you know something that the consensus of investors doesn't know.
If I could know only one thing about every investment that I was considering, it might be how much optimism is priced into the shares.
The third principle of Howard's investment process is value investing. He believes in buying securities at a discount to their intrinsic value. This principle is rooted in patience and discipline.
It's not what you buy, it's what you pay. And success in investing doesn't come from buying good things, but from buying things well.
Howard reminds us of the important relationship between price and valuation in investing, suggesting that it's not just about finding good assets, but acquiring them at the right price. Good investing is about figuring out the value of something and then buying it for much less. Howard continues, "Value investing is, at its core, the marriage of a contrarian streak and a calculator." The next theme we are going to explore are market cycles. This is something Howard has stressed over and over again. In fact, he dedicated an entire book to the topic. Recognizing and understanding market cycles is critical. Howard stresses the importance of understanding where the market is in its cycle to make better investment decisions.
I believe that there are cycles and that they're extremely important to understand. I believe there always will be cycles. I have followed cycles for 50 years. I think I've been able to help our clients by dealing with the cycles.
Cycles are inevitable. Every once in a while they reach extremes that seem to make little sense. And it's at those times that the best profits are available and the greatest losses are to be avoided. Here, Howard is clearly emphasizing the cyclical nature of markets and the opportunities and risks that are present at extreme points.
Why is the understanding of market cycles so important?
Well, the world is cyclical. Everybody knows that the market and the economy and politics move cyclically. And, nothing moves in a straight line where human behavior is involved. And if you were to count on it doing so, you would get into big trouble.
The tendency of the pendulum to swing to excess and then back again is one of the most dependable features of the investment world. This powerful analogy illustrates the oscillating nature of markets, swinging between extremes of optimism and pessimism. We may never know where we're going, but we'd better have an idea where we are. Here again, Howard is stressing the importance of understanding the current position within the cycle to again make better decisions. Number 5 is contrarian thinking. Contrarian thinking is another theme that is woven throughout Howard's investment philosophy. Investing often requires going against the consensus. Howard suggests investors should be willing to be contrarian when the crowd is overly optimistic or pessimistic.
In order to outperform, by definition, you have to depart from the crowd. You have to hold a different position, and you have to have resolve to do it.
Being a contrarian isn't about just being different. It's about being different and being right. You can't do the same things as others do and expect to outperform.
But my whole career has been built on doing things that were uninvestable. As you said, high yield bonds in 1978, distressed debt in 1988, emerging market equities in 1998. These are all things that were under a cloud at the time we started, and they've been successful. That doesn't mean you should buy everything that everybody else considers uninvestable, but that is the place.
Marx highlights the importance of contrarian thinking and accepting the possibility of being wrong in pursuit of superior returns. Number 6 is long-term thinking. Howard advises focusing on long-term results rather than short-term gains. He believes the most important thing is being patient and realizing that investments don't always work out right away. But over the long term, the patient investor is usually rewarded.
Said it's time, not timing, that produces great results.
He also writes, patience and long-term thinking are crucial. The best investors are those who can stand back, assess the situation dispassionately, and make rational decisions based on a long-term outlook. Being disciplined is Howard's next principle. Sticking to your investment strategy and not being swayed by market emotions is essential for success. It's not easy to stay patient and resist the temptation to chase the market during its booms, but those who do are usually the ones who perform best over time. Here, Howard is clearly advocating for patience and discipline, especially during market booms when the temptations to chase returns is stronger.
I believe strongly that success carries within itself the seeds of failure, and failure carries the seeds of success.
Investors need a process and the discipline to stick with that process. Number 8 is humility and caution. Marx highlights the importance of being aware of what you don't know and cautious in making decisions. Humility in the face of the market's complexity is vital.
If you're the kind of person who has to be right all the time, you shouldn't be in investing.
You're also a fan of Peter Bernstein, I believe, and I just wanted to read a quote from him.
Yes.
Humility is an enormously important quality. You can't win without it. Survival in the end is where the winners are by definition, and survival begins with humility.
Number 9 is probabilistic thinking. Investing is about probabilities, not certainties. Howard encourages investors to evaluating the range of possible outcomes and their likelihood. Investing is not a matter of predicting what will happen, but rather a matter of determining the probabilities and paying attention to risk versus rewards. Howard reminds us that the future is not knowable, and thus you must think in terms of scenarios, probabilities, and alternatives, not certainties. Number 10 is focus on fundamentals. Despite market noise, Howard insists on focusing on the fundamental value of investments, such as earnings, cash flows, and asset values, rather than market sentiment or short-term trends.
You know, in investing, there are two basic approaches. One is called top-down, where you say, well, what's the industry, what's the economy going to do? What are rates going to do? Which sectors of the economy will do best? Which industries will do best? Let's find some companies. That's one way to do it, top-down or strategic. The other way to do it is bottom-up. What's cheapest today? And that's more opportunistic, less strategic. And really, that's the way we operate. So
Howard warns against the dangers of forecast. No one knows the future.
Sure. Number one is that people believe in the ability to predict the future. Either their ability or others that they can identify. And in general, I agree with John Kenneth Galbraith, who said there are two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. So I think that the average person has to learn that they don't know what the future holds, and nobody else does either.
You can't predict, you can prepare. Our gift. Earlier in this video, we promised that we would share how you can stay on top of what Howard Marks is thinking and writing about right now. So here it is. While many people know that Howard writes memos, few people know where to find them. In fact, his very first book, The Most Important Thing, was taken from the memos that he had writing over the years. Howard writes these memos because it helps him clarify his thinking. By writing, he organizes his thoughts. You can sign up for his memos to be emailed directly to you as soon as he publishes them by visiting www.oaktreecapital.com. Next, click the Insights tab at the top of the page when this page loads. You will see a subscribe button just under Insights. You should know that you will get lots of other information about Oaktree's investments as well as Howard's memos. If you would prefer to just get his memos, then you should bookmark this page. You will also notice that you can listen to a version of his meme called Behind the Memo. All of his written memos are and have been archived. Enjoy! Here is a quick summary of the 10 investment principles we covered. Number 1, risk management. This forms the foundation of investing. Number 2, second-level thinking. Start thinking differently. Number 3, value. Buy investments at discounts. Number 4, market cycles. Know where you are. Number 5, contrarian. Go against consensus, but be right. Number 6, long-term thinking. Be patient. Number 7, be disciplined. Don't be swayed by emotions. Number 8, be humble. Be aware of what you don't know. Number 9, probabilities. Investing is about probabilities, not certainty. Number 10, fundamentals. Focus on earnings, cash flow, and assets. Additional resources. We could not possibly cover all of Howard Marks' investment philosophy or advice in this short video. If you would like to learn more, we have put lots of other resources in the description section below, many of them free. Finally, thank you for making it this far. If you have enjoyed this video and want to continue to learn more, please subscribe now so you don't miss any of our content or free resources. Additionally, feel free to watch another one of our videos or download a free copy of our top 100 must-read books in finance and investing. There is something for everyone.